Okay, let's unpack this.
Let's do it.
We are diving into a topic that sounds, on the surface, like pure bureaucracy and accounting, but trust me, capital gains tax, or CGT, is one of the most powerful, complex, and behaviorally fascinating forces in modern finance.
It absolutely is. I mean, CGT is often just boiled down to a single percentage on a tax form, right?
Hmm.
But its real significance, its real power is in how it influences investor decisions all over the world. It doesn't just collect government revenue. It dictates when capital moves, when it stays put, and really how efficiently markets operate.
Yeah, it's a key piece of the puzzle for anyone managing, any significant amount of assets.
For sure.
So our mission today is to move far beyond that simple definition. We're going to use our stack of sources to map out the hidden friction points, exploring the surprising behavioral economics, including that famous and totally irrational locked-in brain phenomenon. And then we'll take a detailed tour of the wildly different ways countries treat this exact same type of profit. We're basically giving you a shortcut to being well-informed on global capital flow and policy.
That's right. But before we get into all the behavioral quirks and the psychology, we really need a crisp, solid foundation.
Agreed.
Let's just start with the basics of what we're actually taxing here.
Absolutely. So what is the core definition of a capital gains tax, and how does it, what's the actual difference between it and something like income tax?
So at its heart, CGT is a tax on the profit you make, the profit you realize, when you sell what's called a non-inventory asset.
And that distinction is crucial, isn't it?
It is. Income tax is for funds you earn from labor, like your salary, or from active business, like selling goods and services. CGT is for the appreciation and value of something you just owned, passively.
And when we say non-inventory assets, what are we usually talking about? What are the classic examples that people would recognize?
Well, the list is pretty long, but the most common ones are things like publicly traded stocks and bonds, interest in a private business, precious metals, real estate, and sometimes even, significant personal property like high-value art or collectibles.
And the calculation of that profit is key, right? It's not the total sale price that's taxed.
Correct. So important to remember. The profit is the difference between what you sold it for and the original cost base.
The cost base being what you paid for it.
Exactly what you paid for it, plus any major improvements you might have made along the way that you haven't already deducted. That net difference is your taxable gain.
We know the tax rate itself is rarely universal, though. It often depends on the seller's own financial situation, and governments tend to set boundaries.
Precisely. In a lot of places, the CGT rate depends entirely on your overall income level, what they call your marginal tax rate. And on top of that, governments usually set a lower boundary, an annual exempt amount, or an allowance.
So if your profit is small enough, you're fine.
Right. If your profit for the year falls below that limit, you pay zero tax on it. It just minimizes the administrative headache for small, occasional investors.
And the ability to offset losses, that feels like a crucial feature that makes it different from other taxes. It's often the first tool investors learn to manage their liability.
Oh, it is. If you sell asset A for a big gain, but then you also sell asset B at a loss in the same year,
Which may have declined in value.
You can typically offset that loss against the gain. This means you only pay tax on the net profit you realized.
Not the gross profit from that one winning asset.
Exactly. And this feature is absolutely central to the legal strategies of tax planning we're going to get into later.
Okay, now let's jump straight to something that was genuinely surprising in our sources. The Zero Tax Club. I find it kind of astonishing that some stable modern economies just decide to forego this tax revenue completely.
It's a real global outlier, but they are generally very successful economies. Our sources highlight a whole list of nations that just don't impose a general, broad capital gains tax.
And who's in this club?
It includes places like Bahrain, Barbados, Belize, the Cayman Islands, the Isle of Man, Jamaica, Sri Lanka, and crucially, major financial hubs like New Zealand and Singapore.
Okay, New Zealand and Singapore, these are sophisticated first world economies?
Yeah.
That feels like it's just inviting mass tax avoidance for wealthy citizens. How do they stop everyone from just labeling all their money-making as tax-free capital gains?
And that is the essential nuance, It really highlights a major philosophical difference in their tax codes. They draw a very clear line, and it's based on the intent of your activity.
Intent.
Yeah. If you are a passive investor, meaning you buy a stock, you hold it for years, and then you sell it, that appreciation is generally tax-free.
But what if I quit my job and start day trading every day?
Ah, well then the state reclassifies your activity. If you're deemed a professional trader, or if your trading is frequent and systematic with quick turnover,
Hmm.
those profits are legally reclassified as standard business income, and then they get taxed under the regular income tax system, which is usually progressive.
So they get the professional traders, but they leave the passive long-term investors alone.
That's it. They eliminate the tax for the buy and hold crowd, but they make sure that any true entrepreneurial or business trading activity pays its full share.
So the absence of CGT doesn't mean no tax on investment profit. It just means they've shifted the definition of that profit away from what we traditionally call capital.
Exactly. It's a focus on classifying your behavior rather than just the asset. It's a clean slate for the small, long-term investor, but they stay very vigilant against anyone trying to game the system by running a business that's disguised as passive investing.
That sets the stage perfectly for part one. We're now diving into the psychology and the economics of this tax as an active obstacle to selling things.
This is where behavioral economics really comes into play. When an investor is deciding whether to sell an asset, they think about simple transaction costs, broker fees, commissions.
Sure.
But CGT acts as this other, often much, much larger cost barrier that really discourages investors from pulling the trigger.
It changes the risk equation completely. Our sources say this cost barrier negatively affects investors' willingness to trade, which in turn can actually affect overall asset prices and market liquidity.
It just introduces a huge amount of friction. I mean, think about it. When you have a massive unrealized profit, say a stock you bought for $10 that's now worth $100, that $90 gain is just sitting there, locked away.
Untaxed.
Untaxed. And if you know that selling it means surrendering, say, 25 or 30% of that profit immediately to the government, you need a much, much stronger reason to sell now versus just holding on.
And this is where things get really interesting.
Okay.
The locked-in effect. It sounds like a psychological trap, but the financial logic behind it is actually completely rational, isn't it?
Oh, it's perfectly rational. From a pure wealth management point of view, you have to remember, capital gains are taxed only upon realization, the sale.
Right.
So if you choose not to sell, two immediate financial benefits kick in. First, the tax payment is just postponed indefinitely.
Dig down the road.
And second, that money that would have gone to the government as tax right away, let's call it the tax liability portion, it stays invested in the asset.
Which means the underlying asset continues to compound and grow, not just on your original investment, but also on the government's slice of the profit.
Precisely. You are, in effect, getting an interest-free loan from the government for the amount of tax you owe, and you get to invest that loan in a profitable asset. That compounding effect is incredibly powerful over time.
And this ties back to that financial concept of present value, which is usually where people's eyes glaze over, but we need to make this clear.
Yes.
Even if the absolute tax amount you pay is larger years from now because the asset grew more, the value of that future payment, discounted to today's money, is lower.
That's the key technical point. If I owe $10,000 in tax today, that's $10,000 I lose immediately.
Gone.
But if I owe $15,000 in tax 10 years from now, that $15,000 is worth significantly less than $10,000 in today's money because of the time value of money and, inflation. So the longer you defer the tax, the more you reduce the present discounted value of that liability. This creates this powerful, rational incentive to hold on to assets much longer than their pure economic value might suggest just because of the tax. The asset becomes locked in.
The theory is strong, but did academics actually see investors behaving this way? Our sources point to a 2006 study by Li Jin, which gives us some fascinating insight into investor psychology based on the size of their gain.
Jin's research provided real, concrete evidence. She found that when investors were sitting on huge capital gains assets that had doubled or tripled, they were actively discouraged from selling.
The tax bill was too scary.
Exactly. The fear of triggering that massive tax bill outweighed the desire to take profits. This just dramatically reinforced that locked-in effect.
But the flip side of her research was even more surprising.
Yes. Conversely, she found that assets with small capital gains, or even ones that were slightly in the red, they tended to stimulate trade. Investors were quicker to sell and realize those small profits or small losses.
So the tax hit wasn't psychologically or financially scary enough to stop them from rebalancing or taking a small win.
Right. It didn't override their fundamental desire to do something with their portfolio.
That is completely counterintuitive to the average person. You'd think a massive profit is the perfect time to sell, diversify, take some money off the table.
You'd think so.
But the research suggests the investor is making this instantaneous, high-stakes calculation. They have to believe the stock is going to go down permanently for them to be willing to trigger that huge tax bill right now.
That's the explicit economic model that the tax implies. CGT introduces such a high switching cost that the investor has to be deeply pessimistic about where that asset is going before they're willing to accept the immediate tax liability.
And that inertia means capital just sits there in potentially underperforming or over-concentrated positions, just waiting for a catastrophe or a tax policy change to make it worth selling.
And this observed behavior is what fueled that famous revenue debate with the economist Martin Feldstein, who was a former chairman of the Council of Economic Advisors. He made a very bold, policy-altering claim based on this exact locked-in phenomenon.
What was the claim?
He argued that the locked-in effect had frozen so much wealth in the market that the elasticity of supply, the willingness of people to sell, was enormous. Therefore, he said, if the government reduced the CGT rate, people would just flood the market with sales of those assets they'd been holding on to for years.
So his claim was that the surge in realized gains would be so big that government revenues would actually increase even with a lower tax rate.
Exactly. It's the classic Laffer curve argument, but applied specifically to capital assets. Lower rates could yield higher total revenue.
That's a huge claim.
Yeah.
Did policymakers buy it? And did the data ever definitively prove it one way or the other?
Well, it was hotly debated. Our sources cite some 1994 estimates which suggested that while a temporary reduction in the capital gains tax rate would definitely cause a massive short-term surge in sales.
Because people would rush to take advantage of it.
Right, investors timing their sales perfectly. But a permanent reduction would likely have very little long-term effect on revenue.
Why the difference between temporary and permanent? That's interesting.
Because if the rate change is temporary, you have to sell now to get the benefit.
Yeah.
That overcomes the locked-in incentive.
Right.
But if the rate change is permanent, the incentive to defer the tax to get that interest-free loan and the compounding, it still exists, just at a slightly lower rate. The fundamental behavioral trap is still there, so that temporary boost to revenue just fades away as the market settles into a new normal.
And bringing this up to modern relevance, especially with the high inflation we've seen recently, there's a growing argument that CGT systems have to adjust for inflation.
This is a critical point that really impacts the true efficiency of investing. Let's use a simple example. Say 10 years ago, you bought a piece of land for $100,000.
All right.
Today, you sell it for $150,000. Your nominal gain is $50,000.
And that $50,000 is what the government typically taxes.
Exactly. But what if, over that same decade, general inflation was 30%? Well, then $30,000 of your $50,000 gain is just the loss of your currency's purchasing power.
Right. You haven't truly gained wealth on that $30,000 portion.
You've just maintained your real capital. You just kept up with inflation.
So if the government taxes that full $50,000, they are taxing what economists call fictional gains. They're literally taxing inflation itself.
Precisely. They are eroding your real capital. And this actively discourages necessary long-term investment because the after-tax, real rate of return is artificially pushed down. It forces investors to seek higher risk, high-return ventures just to break even after inflation and tax, and that can lead to less efficient capital allocation in the long run.
That is such a powerful argument for complexity, that a simple percentage is never as simple as it looks if it ignores real economic factors like inflation.
It just confirms that CGT is an incredibly subtle policy instrument. It often has these unintended consequences that distort behavior and efficiency.
Speaking of distortion and inefficiency, let's transition into part 2 and look at the actual cost of administering and complying with this tax. These are the hidden friction points that policymakers often just gloss over.
Yeah, these are the administrative and compliance costs, the sheer weight of the bureaucracy, and the burden on you, the taxpayer. These costs are a real drain on economic resources, and they have to be subtracted from the total revenue collected to figure out the net benefit of the tax.
Let's start with the government's side, administrative expenses. This is the cost of actually running the system. The payroll for auditors, the software, the forms, the legal battles.
Our sources note how difficult it is to isolate the precise costs just for CGT collection. Since CGT is often structurally tangled up with the general income tax systems, it's really rare to find an itemized cost analysis just for capital gains.
So we have to rely on proxies for the sheer operational overhead. What's the best proxy data we have?
We can look at some Canadian research from 1989. This study looked at the administrative costs for personal income tax and two major payroll taxes. They found that the total cost for processing, administration, capital, litigation, all of it, was about 1% of the gross revenues collected from those three sources combined.
1% doesn't sound astronomical, but when you're talking about billions or trillions in tax revenue, that 1% is a huge sunk cost just to keep the machinery running.
It is, and that's only the internal government cost. The more staggering element is the external burden, the compliance costs that are borne by the taxpayer.
Right, compliance costs being the expenses you, the taxpayer, have to pay just to fulfill the requirements. This is your record keeping, calculating your cost basis, paying for an accountant.
Exactly. I mean, just imagine trying to reconstruct the cost basis for a stock you bought 20 years ago through a brokerage that has since been bought out 3 times.
A nightmare.
The documentation required for CGT, especially for long-held or complicated assets, is immense.
And we have some pretty striking quantifiable data on this from a 1992 U.S. study of households in Minnesota. The figures are old, but they really illustrate the burden on the individual.
Oh, they absolutely paint a clear picture of the friction. The survey compared households that had capital gains income to those that didn't. And the authors found that simply receiving capital gains income increased the time spent on taxes by, get this, 7.9 hours.
Wow. Almost a full day of unpaid labor just to calculate the gains, track the basis, and fill out the forms correctly.
And that translated into real money, even in 1992 dollars. The study showed it increased the money spent on professional tax help by about $21, which is closer to $45 today, and increased the total compliance cost by $143 per taxpayer per year.
Now, I have to challenge this data a little bit. If the compliance burden was almost 8 hours back in 1992, today, in 2024, with fractional shares, crypto, international holdings, I mean, surely that time burden is exponentially worse, even with modern software.
That's a very fair challenge, and I think the answer is almost certainly yes. While we don't have a comprehensive modern study with the same rigor, the complexity of modern finance has just exploded. Think about tracking the cost basis for investments you made through multiple different trading apps or stock splits and mergers or international reporting. The time required for accurate basis tracking is the single biggest friction point for the average investor today.
So that $143 figure is a floor, not a ceiling, for today's burden. It just underscores that compliance costs are a real, tangible economic drain that consumes productive resources. It forces people to spend time calculating tax instead of, generating wealth.
The conclusion is that these hidden friction costs are a critical, often ignored consideration when setting tax policy. A tax system that's too complicated can become self-defeating by consuming too much of the wealth it's trying to tax.
This friction and cost naturally lead us into part 3. The active ways people try to legally manage this tax deferral and avoidance, and then the illegal side, evasion.
Right. Tax management for CGT often revolves around deferring that tax trigger point, using specific rules to your advantage, or shifting the liability to a more favorable situation. This is the art of minimizing what you owe while staying within the law.
So what are some of the most common and effective legal deferral strategies that our source material highlights?
We see a lot of strategies that are tied to policy priorities. For instance, many nations offer lower tax rates or specific deferral benefits for investments in government-favored sectors, like small businesses or tech startups.
So they're trying to steer capital toward riskier, more beneficial economic areas.
Exactly. And then there's playing the family income brackets. This is a classic avoidance technique in progressive tax systems.
Tell me more about that.
So the classic family transfer, often used for real estate or appreciated stock, in a place like the U.S., you could transfer ownership to a low-income family member. When they eventually sell, they might fall into the lowest income tax brackets, potentially qualifying for a 0% federal CGT rate. You've legally shifted the taxable amount to someone with a lower rate.
The power of tax-favored accounts, like retirement or savings plans, has to be mentioned too. They're probably the single greatest deferral tool for most people.
They're absolutely essential. These accounts let your capital gains and other investment income grow tax-free until you withdraw, often decades later. They are massive, government-sanctioned deferral mechanisms that basically neutralize the locked-in effect inside the account.
Let's talk about tax loss harvesting. It sounds aggressive. You're actively selling things at a loss, but it's totally legal and even encouraged by the tax code.
This is critical for active investors, especially late in the tax year. It involves selling an asset that's currently underwater at a loss, specifically to generate a tax loss.
And that loss is then used to offset or harvest capital gains from other profitable sales.
Right, reducing your net taxable gain for the year.
Is there a catch? Can I just sell my stock at a loss, claim the deduction, and then immediately buy it back?
No, you can't. That's where the anti-avoidance rules come in, like the wash sale rule in the US. You have to avoid these sham transactions, usually by waiting a certain number of days, typically 30, before you buy back the same security.
Okay. We also saw strategies tied to charitable giving and installment sales for big physical assets.
Indeed. Donating a highly appreciated asset directly to a charity is very powerful. You get a deduction for the fair market value of the asset, and the tax on the capital gain itself is often waived entirely.
And for big things like commercial properties.
An installment sale lets the seller receive payments over several years. This spreads the tax liability out over time, though, of course, you have to manage the risk of the buyer defaulting.
And for generational wealth, the basis change rule on inheritance in the U.S., the stepped-up basis, is arguably the single most important legal deferral tool out there.
It is the ultimate deferral mechanism. When an asset is passed down at death, the original cost basis, what the deceased paid for it, is completely reset,
Wiped clean.
or stepped up to its fair market value on the date of inheritance.
Let's walk through that specific scenario slowly, just for clarity.
Sure. Imagine your great-grandmother bought some land for $1,000 back in 1950.
Okay.
When she passes away, that land is now worth $1 million. The full gain of $999,000 is still unrealized. When you inherit it, your legal cost basis becomes $1 million.
So if I sell it the next day for $1 million,
Your taxable gain is zero. The entire $999,000 gain that built up over 70 years is wiped clean for tax purposes.
the locked-in gain is permanently eliminated. That solves the deferral problem for generational wealth. That's huge.
It is. This rule is a massive incentive to hold assets until death, and it dramatically reinforces the locked-in effect for people planning those kinds of transfers.
Two specialized U.S. deferral methods also jumped out: the 1031 exchange for real estate and the Opportunity Zone program.
The 1031 exchange, or like-kind exchange, lets you defer CGT indefinitely if the money from the sale of an investment property is immediately reinvested into a like-kind property of equal or greater value.
So you're just swapping one investment property for another and rolling that tax liability forward.
Exactly. It's a mechanism for continuous deferral. It used to be broader, but the 2017 tax reforms restricted it almost entirely to business-related real estate and tangible property. You can't swap collectibles this way anymore.
And the Opportunity Zone program sounds like a strategic attempt by the government to use the locked-in effect as a policy tool.
That was the explicit intent. The program was created to lure capital that was otherwise frozen because investors didn't want to trigger CGT into designated low-income areas.
And how did they lure it?
By reinvesting your realized gains into these opportunity zones, you could defer your original gain and, crucially, potentially pay zero tax on any new gains from the opportunity zone investment if you held it for a decade. It was designed specifically to recycle frozen capital into community development.
That's a fascinating list of legal moves to minimize or defer the tax. But now we have to turn to the really negative side. Tax evasion, the illegal failure to report or pay.
Evasion is the difference between the actual revenue that's collected and what should have been collected if everyone followed the law. And it's not just a fairness issue, it's an efficiency loss. Resources spent hiding wealth or auditing complex schemes are resources that aren't being used productively elsewhere.
Can we quantify this link between high CGT rates and more evasion? Does evasion go up in a straight line with the tax rate?
Academic studies confirm there's a relationship. Potterbaugh's 1987 work found that a 1% decrease in the CGT rate increased the reported tax base by 0.4%.
So it still meant less tax was collected overall, but it showed that lower rates do encourage more reporting.
Right. But the more striking data comes from a very specific and unique data set. The shareholder info after the massive RJR Nabisco leveraged buyout in 1989. This gave a rare window into actual evasion behavior.
What did they find?
A 2002 study by Landsman and others estimated that for every 1 percentage point increase in the marginal tax rate on capital gains, there was an associated 0.42% increase in evasion. High rates directly incentivize illegal underreporting.
And the number that really stands out from that study is the average level of evasion they detected.
Yes. The authors calculated that the average level of evasion detected in that specific transaction was 11% of the total capital gains realized.
11%. That is a massive black market for capital gains. Doesn't that mean that the government, by chasing an artificially high rate, is actively penalizing the 89% of people who are honestly complying, just to collect a theoretical rate that 11% are easily dodging?
That is the policy dilemma in a nutshell. It underscores that fundamental trade-off. High rates promise higher revenue if they're collected, but they also amplify the incentive for both legal avoidance and illegal evasion, potentially canceling out the intended revenue increase while making the system more complex and damaging its integrity.
This tension between the rate, compliance, and behavior brings us perfectly to Part 4, our global gallery. We've established the fundamentals, the locked-in effects, and the friction costs. Now we get to see the vast mosaic of how different countries try to solve this policy puzzle.
The variety is truly astonishing. We can sort of group the systems by how they integrate CGT into their income tax structure or how they use flat rates to make things simpler.
Let's start with integration countries that don't treat CGT as a separate tax, but just fold it into the normal income calculation. Australia is a prime example, but it has a major twist.
Australia's system is fascinating. CGT is a component of the income tax system, and it applies worldwide. The capital gain is calculated, and then a major discount is applied.
Tell us about that discount. It seems like a huge incentive for long-term holding.
It is. For individuals and some trusts that hold an asset for over 12 months, there's a generous 50% capital gains tax discount.
50%.
So only half of your realized gain is added to your assessable income and then taxed at your marginal rate. So if your top income tax rate is 40%, your effective CGT rate is only 20%.
That 50% discount feels like a policy tool designed to compensate for the fact that they don't adjust the cost base for inflation.
That is exactly the policy hypothesis. While Australia doesn't explicitly adjust for inflation, meaning they are still taxing those fictional gains, the 50% discount acts as a kind of blanket solution.
A blunt instrument.
Right. It assumes that roughly half the gain over a year is either inflation or just a reward for long-term commitment. It's a simplification that tries to solve the inflation problem without the administrative nightmare of indexing every single asset's cost basis year after year.
Now contrast that with Estonia, which takes integration to an extreme level of simplicity.
Estonia is remarkably streamlined. They have no separate CGT at all. It's simply taxed the same as regular income at a flat 20% rate.
Okay.
But the fascinating detail is for corporations. Companies there pay that 20% tax only when they distribute dividends or profits.
So they can defer tax on all their retained earnings, even realize capital gains, as long as the money stays in the company.
Yes, it massively encourages reinvestment. It's a huge incentive for growth companies. They can realize gains, reinvest them, and just keep deferring that tax liability.
It's all about encouraging internal capital formation.
Precisely. Uganda is similar for individuals. Capital gains are just included in gross income. And Argentina taxes residents progressively from 9 to 35% on their worldwide revenue, which includes gains.
Moving on to pure flat rate systems, where simplicity is the main goal. Which countries just choose a single clear percentage?
Cyprus, for instance, has a fixed 20% rate, but it's specifically focused on property or shares in companies that mostly own property in Cyprus. Italy uses a clean, flat 26% rate for individuals. Poland is also very simple, with a flat 19% on capital income.
Ireland, with its 33% rate, seems quite high, and that caveat about inflation is crucial there.
Ireland's rate is 33%, and unlike Australia, they generally offer no mechanism for inflation adjustment for assets acquired since 2003, so that 33% headline rate bites much harder in real terms, especially over long holding periods, because it's definitely taxing fictional gains.
Do they do anything to soften that blow?
They do, slightly. There's a modest annual exempt band of €1,270.
And Mexico has created a very specific low flat rate that's targeted at encouraging one type of investment.
Yes, Mexico taxes stock market profits at just 10%. This is often done to increase the formalization of their stock market and encourage broader participation by making it significantly more attractive than other forms of saving or investment.
Okay, next, let's look at progressive rates and the mechanisms designed specifically to reward long-term holding, actively incentivizing the locked-in effect, but making it beneficial for the investor in the long run.
Right, so Spain and Turkey operate progressive systems linked to income or the size of the gain. Spain goes from 19% up to 28%. Turkey's rates are higher, from 15 up to 40% based on income.
But the gold standard for rewarding patience has to be Slovenia's sliding scale. It's an incredibly clear policy signal to the market.
Slovenia is the most explicit example of using the tax code to change holding behavior. Their rates start at 27.5%. The rate is then reduced systematically for every 5 years you own the asset.
Walk us through that sliding scale.
So the rate drops to 20% after 5 years, then 15% after 10 years, and 10% after 15 years. And if you hold the asset for 2 full decades, 20 years, the rate drops all the way to 0%.
0% after 20 years. That is a massive multi-decade incentive to just put your asset away and forget about it. It stabilizes capital and provides a huge tax-free payout for retirement planning.
Exactly. It completely eliminates that realization trigger after that period. But they do balance this generosity with a very high initial rate, a 40% rate specifically for derivatives sold in under 1 year to aggressively discourage short-term speculation.
The UK also uses tiered rates, but adds complexity by differentiating based on the type of asset, favoring things other than residential property.
Right. The UK system clearly distinguishes between asset types. Basic rate taxpayers pay 10% on non-property gains and 18% on residential property gains.
And for higher earners.
Higher rate taxpayers pay 20% on non-property gains and a much steeper 28% on residential property profits.
Why is residential property tax so much higher? Is that designed to discourage housing speculation?
That's often the explicit policy goal. We even see historical evidence of this in the UK. CGT was introduced there in 1965, largely as a direct response to property developers who were deliberately leaving new office blocks empty.
Really?
Yeah. They would avoid rental income, maximize a capital gain over time, and then sell, exploiting the lack of a CGT. The tax was a direct tool to curb speculative holding of necessary resources.
That anecdote perfectly illustrates how tax policy isn't just about revenue. It's a specific tool to change market behavior.
It's market engineering.
Finally, let's look at the unique national exemptions and structural quirks that make this tax landscape so complex and interesting globally.
This is where we see true national philosophical differences, and we can start with the most common and universally accepted exemption, the principal residence exemption.
This is the family home exemption. Why do so many countries agree on this one?
Because the home is seen as a necessary good, not strictly a business investment. Countries like Australia, Canada, France, and Norway typically exempt the gain you realize on the sale of your family home.
Are there variations?
Oh, yes. The variations are in the details. Did you rent out a part of it? Did you run a business from it? In the Czech Republic, the gain from your primary home is tax-exempt if you've held it for at least 3 years, which shows that even the exemption is tied to a holding period incentive.
Now, let's dive into the Netherlands box system. This is perhaps the most radical deviation from the CGT concepts we've seen so far.
It's a completely different paradigm. The Dutch system uses 3 boxes for income. Box 2 taxes substantial shareholdings, 5% or more, at a flat 25%.
But it's box 3, which covers general savings and investments, that completely ignores the realization event and, more importantly, ignores the actual gain or loss. How does the government justify that?
Box 3 taxes a theoretical capital yield. Instead of tracking your actual sales, the government just assumes a fixed rate of return, let's say 4%, on your savings and investments above a certain threshold.
And then you pay tax on that assumed number.
You pay a 30% tax rate on that assumed 4% yield. The key takeaway is profound. The actual gain or loss you made in the market is utterly irrelevant to your tax bill.
So wait, if I invested 100,000 euros and the government assumes a 4% yield, they say I earned 4,000. I pay 30% of that, or 1,200 euros, in tax.
Right.
But what if I had a terrible year and actually lost 5,000 euros?
You still pay tax on the assumed 4,000 euro yield. That's the fundamental philosophical trade-off. It drastically simplifies compliance for millions of people, but it completely detaches the tax liability from economic reality. The philosophy shifts from taxing realization to taxing the capacity to earn wealth.
That is a staggering concept. It certainly eliminates the locked-in effect, because selling or holding makes no difference to your tax bill that year.
Precisely. You're incentivized to invest efficiently and realize gains freely because the tax is levied regardless.
Norway also uses a very complex mathematical equation designed to achieve financial neutrality in its shareholder model. using a specific multiplier.
Norway's system is designed to harmonize the tax on capital and labor and to avoid double taxation of corporate earnings. They do this with a specific mechanism. Capital gains on stocks are multiplied by 1.44 before the standard 22% tax is applied,
Which results in a much higher effective rate.
an effective rate of 31.68%.
Why that strange 1.44 multiplier? What is financial neutrality?
Financial neutrality means ensuring that you aren't choosing between investing in a stock or earning a salary based purely on which one has a lower tax rate. The multiplier brings the effective tax rate on equity gains up to a level that approximates the tax rate on ordinary labor income after corporate tax is accounted for.
And they include a deductible allowance to secure this neutrality.
Yes. The system also includes a deductible allowance, which shields a portion of the gain based on the average interest rate for risk-free investments like Treasury bills. This basically returns to you the portion of the gain you could have made passively, exempt from this extra tax.
So it ensures the tax only targets the excess return you get from taking risk in the stock market.
Exactly. It encourages you to invest for true economic reasons, not tax optimization. It's incredibly complex, but designed for stability.
Finally, let's contrast Switzerland and Hong Kong, two major financial centers, with wildly different approaches, despite both being low-tax jurisdictions.
Switzerland is famous globally because generally individuals pay no CGT on securities trades. For the wealthy private investor, this is a massive advantage.
But you mentioned earlier they have a very strict set of criteria to make sure you're not abusing that by basically running a business disguised as passive investing.
Yeah.
They are policing behavior aggressively.
They are. If the tax authorities classify you as a professional trader, your gains are immediately taxed as ordinary income, plus they're subject to social contributions. To stay tax exempt, you have to follow several safe harbor criteria. They're a behavioral blueprint for staying passive.
Walk us through those safe harbor criteria. What are the limits?
There are 5 key rules. 1, you have to hold each security for at least 6 months.
To deter short-term speculation.
Right. 2, your total trading volume has to be less than 500% of your starting capital.
To limit day trading.
3, your realized capital gains must make up less than 50% of your total income. 4, you have to have a low or no use of debt to finance the trades. And 5, any derivatives have to be used solely for hedging your own portfolio, not for aggressive leveraged betting.
That is incredibly detailed. It shows that even in a zero-tax environment, the government has a powerful surveillance system focused entirely on the intent of your transactions.
It's behavior modification through definition. Now, contrast that with Hong Kong. While it's generally CGT-free, they have a major complexity issue for international employees.
The issue of vesting shares.
Exactly. When employees get shares or options as compensation, Hong Kong treats that as employment income and taxes them at normal income rates on the value when they vest. This creates enormous complexity and potential double taxation when employees move internationally.
Why the double taxation risk, especially since Hong Kong is known for its simple tax system?
Because Hong Kong has relatively few comprehensive double tax agreements compared to major Western nations. So if an employee vests shares while moving between a country with high CGT and Hong Kong, they might pay full income tax on the shares in Hong Kong and still be liable for a capital gains tax in their home country when they eventually sell. It's a huge friction point for global talent.
Wow. We've covered the entire spectrum, from total zero-tax environments to systems that tax theoretical capacity, and from simple flat rates to sliding scales that reward 2 decades of patience.
It just confirms that the simple idea of taxing profit is constantly complicated by 3 core things: human nature, with the locked-in effect, administrative friction, with compliance costs, and the vast, often contradictory mosaic of global tax law, with each system designed to solve different economic and social problems.
So what does this all mean for you, the listener? Understanding CGT is critical because it dictates when and how you manage your wealth. It's not a passive feature. It actively influences decisions that go far beyond simple financial optimization. It creates friction, but the system also creates specific, legally defined opportunities for deferral and avoidance.
It's the ultimate example of how taxes don't just extract money, they sculpt behavior. The locked-in effect is a powerful passive force that shapes markets by encouraging inertia. Compliance costs are an active drain on efficiency. And the global variation means that the highest tax rate isn't always the most efficient, nor is the lowest rate necessarily the simplest to navigate.
That brings us to our final provocative thought. Given the immense power of the locked-in effect, and all the evidence that CGT creates friction against slowing down capital movement. What would happen to capital fluidity and new investment patterns if all major countries globally adopted a system like Switzerland's securities exemption or the Netherlands' Box 3 theoretical yield system?
It raises a profound question about market efficiency. If investors were truly forced to realize their gains freely without that immediate tax consequence hanging over them, would they hold assets for genuinely economic reasons instead of tax deferral reasons?
Right.
Would that unlock the vast amounts of frozen capital, that multi-trillion-dollar locked-in pool, and recycle it much faster into newer, perhaps riskier, and more innovative investments? The economic efficiency gains for global venture and capital formation might be huge, even if the state had to radically redesign how it collects revenue in the short term. That's a dynamic worth mulling over.